Welcome to the Deep Dive. We're the place where we sift through, the dense financial reports, the strategy updates, and try to pull out what actually matters for you. Today, we're digging into POSCO Holdings, ticker PKX, and their Q3 2025 earnings call. Now, for you, the seasoned investor probably keeping tabs on PKX, our goal here is simple. We want to cut through the noise. There's a lot of it this quarter, complex structure, some big accounting charges, and figure out what management is really signaling for 2026. Because this quarter, it looked messy. Maybe deliberately messy, but messy all the same.
Yeah, messy is a good word for it, but it's also why this call was so important, I think. You saw the strength in the old school steel business, but also this kind of faster path for the battery material side, all happening while these big one-off items were dragging down the main numbers. Yeah. So, okay, the snapshot first. Consolidated revenue came in at $17.26 trillion. That's down. Quarter on quarter, down year on year.
Right.
But the market seemed to look past that, mostly focusing on operating profit. That landed at $8.64 trillion.
And that OP number, that's really the story here, isn't it? It's the third straight quarter of improvements since they hit bottom late last year. So it suggests the core operations are, working better. GAAP EPS was $9.94.
Exactly. And the market reaction, it was, modestly positive, just a little bump.
Okay.
Which tells you a couple of things, I think. One, investors kind of expected the bad year-over-year numbers, no big shock there. And two, they seem to be buying the story that these big infrastructure charges really are temporary, that they're contained.
So the C-suite message is sort of cautious construction, like bear with us through 2025, it's cleanup time, 2026 will look much cleaner.
That's pretty much it. Setting the stage for a clearer run next year.
Okay, let's unpack it then. Starting with the bedrock, right? Steel. Given everything happening globally, manufacturing slowdowns, construction, how did the core steel business actually hold up?
It actually showed some real resilience. Management flagged a 6.6% operating profit margin, specifically in steel. Pretty solid. And the interesting part is how. It wasn't really better pricing. It was driven by, two things mainly. Really aggressive cost cutting and, surprisingly, a decent rise in sales volume. The average mill margin itself was basically flat compared to Q2, so it was all about efficiency gains.
That definitely points to good internal controls. But you mentioned pricing pressure. External factors must have been hitting them. What was the main culprit there?
Oh yeah, classic market move. Sales prices took a hit because imports just flooded into South Korea. Competitors basically trying to stuff the channel, build up inventory customers before that anti-dumping rule and the AD ruling kicked in.
Right, locking in sales before the duties hit.
Exactly. So that saturated the domestic market. Plus, you still had generally sluggish demand at home anyway.
Yeah.
They do think that extra import inventory should get worked through by the end of Q4, though.
Okay, so short-term pain. But looking longer term, strategically, they're making some big moves in steel, shutting down older, less competitive lines domestically. Where's that investment shifting to?
Yeah, the shift is very clear. It's all going towards higher value, lower carbon stuff. Domestically, it's about electric arc furnaces, EAFs, which are key, right? Because they cut the carbon footprint way down compared to the old blast furnaces. And that fits perfectly with their push into electrical steel, the high margin stuff needed for EVs, for efficient transformers, all
When it overseas, where are they adding capacity?
Key growth markets, India, Indonesia, Australia, and significantly the U.S. That MOU they signed with Hyundai Motors for the plant in Louisiana.
Right.
That really highlights this strategy. It's about securing these high-value, localized supply chains. They're not just churning out any steel. They're making the right steel for where the economy's headed.
That focus on high value is definitely crucial for the long-term story, for the valuation. But, before the market can really appreciate that clean story, we have to tackle the big drag this quarter. Infrastructure. That's where all the noise was.
Absolutely. POSCO E&C. That was the pain point. This is where the company, took its medicine, you could say. In Q3 alone, they booked some really big estimated losses. There was the Shinansen accident fallout, related business suspension costs. It added up to $288.1 billion just in Q3.
Wow.
And it's not over yet. Management was very upfront. Expect another $230 billion in Q4. That's the rest of the business. Interruption losses. They say they'll recognize it all this quarter.
Okay, so add that up. You're looking at over $500 billion. What's that, like $375 million US just in the second half of this year tied to these issues?
Yeah, it's a huge number.
Now, management's line is, these are one-offs. 2026 will be clean. But if you're listening to this, you have to be a bit skeptical, right? And construction, E&C, it's risky business. What did they say to convince people this won't just happen again next year?
That's exactly the right question, and they know the market is asking it. They spent a fair bit of time on the call talking about governance and safety, specifically because of that fear. They've rolled out a big group-wide safety master plan. They're bringing in outside experts like SGS for safety audits. They even launched their own dedicated firm, POSCO Safety Solution.
Okay, plans are one thing, but what's the most concrete change, like on the ground level? Something to actually prevent another accident and another massive write-down?
I think the biggest thing is the shift in authority. They specifically said they've given workers the power to just stop operations immediately if they spot danger.
A stop first, ask questions later.
Exactly. The stop order comes first, the report comes second. It's meant to really hammer home that safety is the absolute #1 priority across the whole group, which, frankly, they need to do if they want the market to finally believe these charges are truly one-offs.
Okay, that makes sense. Now, let's shift gears to where frankly, the real excitement is, the growth story. Rechargeable battery materials. This segment's been losing money, but Q3 saw those losses shrink dramatically. What happened? What drove that?
Yeah, it was kind of a perfect storm, but in a good way. Two main things helped. First, volume growth. POSCO Future M, their cathode business, saw sales volume jump quite a bit.
Okay, why?
Partly because customers were pulling orders forward. They were anticipating that IRA benefit sunset.
Can you just quickly explain what that IRA sunset means in this context?
Sure. It's about the upcoming changes to the U.S. Inflation Reduction Act rules for EV tax credits. The requirements for where battery materials and components are sourced are getting tighter.
Got it.
So customers basically hedging, trying to lock in supply now before the rules change, and that gave POSCO Future M a temporary volume boost this quarter.
Okay, so temporary boost from the IRA deadline effect. What was the second factor?
The second one was pure accounting, really. The lithium operations had booked losses before because lithium prices fell, hitting their inventory value. In Q3, prices stabilized a bit, so they got to reverse some of those previous inventory valuation losses, about $37 billion worth. That reversal alone helped narrow the segment's overall loss significantly.
Right. Management seemed keen to stress Q3 was about execution, not some miracle turnaround. So what's the execution focus now? Which specific projects are key?
Yeah, they're all about disciplined execution now. Ramping up two big new lithium projects, the main thing. First, the Tobar Salt Lake project down in Argentina.
Okay.
And second is PPLS. That's their dedicated processing plant. It's super important because it takes the raw lithium carbonate or chloride and turns it into the high purity lithium hydroxide that battery makers actually need. So the focus is get these plants running efficiently, hit the production targets, and crucially get all the customer qualifications done so they can lock in those long-term supply deals.
Okay, so putting it all together, what's the outlook for lithium actually making money, given how volatile prices have been? When can we realistically expect this segment to be profitable?
They're clearly pointing to 2026. And their price forecast is really the key piece here. They admitted Q3 prices were low, $8, $9 a kilogram range.
Yeah.
But they expect a pretty significant rebound next year. They're targeting $10 initially, maybe even hitting $50 in the second half of 2026.
And what makes them confident in that price jump?
Their own EV demand forecast, mostly. They see the global market going from about 13 million EVs this year up to 16.5 million in 2026. So more demand pulling prices up. And the timing is crucial. They expect the full ramp-up of PPLS and the Argentina plan to happen early next year, just as they anticipate that price recovery starting.
Okay, that makes sense strategically. Let's zoom out a bit from the segments. How are they funding all this big transition? What did the call tell us about their overall capital structure portfolio moves?
They've been really active on the portfolio front. Since the start of 2024, they said they've completed something like 63 different projects.
63, wow.
Yeah, basically selling off non-core assets. That generated about $1.4 trillion in cash. A notable chunk of that came from selling their shares in Nippon Steel, NSC.
Okay, so bringing in cash, where's it going?
Primarily two places. Big, future-focused environmental investments like the HyREX project, that's their hydrogen-based steel-making pilot, and funding all this new capacity, especially in those key overseas growth markets we talked about. They also kept the door open on M&A. Said they're still looking at the HMM acquisition, for example, if it aligns strategically.
Makes sense. Any other macro points they touched on? China regulations?
Yeah, two quick ones. First, China Steel. They expect China to focus more inward, maybe cut some production.
Yeah.
But they sounded pretty confident that recovering demand elsewhere, India, Southeast Asia, US, Europe, would offset continued softness in China next year.
Okay, and the second.
The EU's carbon border tax, CBAM, it affects everyone. They basically acknowledge it's coming. They think the initial paperwork, the certification, will be manageable. But they know the real cost hits start around 2026, 2027 as those free allowances phase out. So they're working on guidelines, trying to figure out how to manage compliance and the costs.
Right, a challenge for the whole industry. Okay, let's pivot. It's time for our segment. This is not financial advice. You know the drill. We digest the data, give you the insight, but we also like to cap off these deep dives with maybe an outrageous but plausible trade idea that flows from everything we just heard on the call.
All right. So my thesis here, it's entirely structural. It's about the timing and how the market sees things. Those huge multi-hundred billion won charges, the POSCO E&C stuff, right now they're acting like an anchor, dragging down the overall consolidated valuation. It's basically masking, or at least muddying, the view of the battery materials segment, which is actually hitting its ramp-up targets and has this potentially huge profit swing coming.
Okay, so the drag is hiding the growth engine. What's the specific trade idea stemming from this Q3 call?
The trade is simply long PKX. The bet is on a significant re-rating, a multiple expansion, happening sometime in 2026.
Why 2026? What's the catalyst?
The catalyst is clean reporting, specifically the Q4 results early next year. Once they report those final E&C charges and frame them as done, as one-offs truly finished in 2025, that should theoretically force the market to look at the company differently, to finally price in the lithium ramp-up, the IRA tailwinds, the solid steel base, without that massive infrastructure drag clouding the picture.
So it's a sum of the parts argument, basically. Betting the market will recognize the value once the temporary noise stalks.
Exactly. It's a bet on the full value of that battery materials business finally being reflected in the stock price once the E&C cleanup is verifiably complete.
That definitely hinges on management sticking the landing with those Q4 charges and convincing the market it's truly over. Okay, quick recap then. Key highlights from Q3. Solid sequential OP improvement. Good sign there. Battery material losses narrowed sharply thanks to volume and that inventory accounting reversal, and a very clear, very expensive plan to get the infrastructure mess cleaned up by the end of this year, Q4.
Yeah, and the final provocative thought I'd leave you with is this. They just raised $700 million in green bonds relatively easily. They're clearly prioritizing spending on this battery capacity. So the real question is, how fast can Tobar and PPLS actually scale up? Can they hit full stride quickly enough to really capture that $15 lithium price target they're hoping for in late 2026? Execution speed on that ramp up is everything for this re-rating story.
Absolutely critical. Execution is key. Well, thanks for joining us on this deep dive into the complex and frankly fascinating POSCO story. If you have earnings calls or reports you want us to tackle, send them our way. Until next time, stay sharp.